Talking to many businesses about finance, even in the most basic language, can seem a little bit overwhelming. After all, accountants spend years studying that sort of caper. So as opposed to getting bogged down in textbooks, today I have come to the Central Library here in Manchester to hopefully meet some people who can talk me through the most basic financial descriptions and definitions. After all, at least it'll save me having to wade through all this stuff. I'm just about to meet a guy called Stephen Lindsay, who's a financial expert for CLB Coopers in Manchester, and he's going to talk us through some of the more commonly used terms and what they mean for business. Stephen, very pleased to meet you.
And you, mate.
Let's start at the very beginning then. What exactly is profit and loss?
Well, profit and loss just shows for a period of time what a business has made in profit, which is just the difference between its sales and its costs.
Okay, what about cash flow and balance sheet analysis?
The balance, whereas a profit and loss account will look at a period of time, normally 12 months, a balance sheet is as at one point in time and just shows the assets and the liabilities that that business has. Cash flow is just that. It's an analysis or a statement of the cash that's come into a business and gone out of a business over a period of time.
Okay, what about key performance indicators, KPIs?
KPIs are whatever the people running a business decide are the essential measures of performance for that business. So it varies by business and it can be whatever they want it to be, and they look at them regularly to monitor the business's performance.
Throughout this series, we're going to be joined by a panel of experts who are all going to add the benefit of their experience. Let's see what they had to say about financial terminology.
I think if you're focusing on the cash in bank, the bank account is purely a reservoir of money, and the cash held within the company is generally within three areas: your debtors, your creditors and your stock, whether you term that stock as being work in progress if you're offering some sort of service industry, or whether it's in product bought. But people do tend to disregard the working capital of the business and look at their bank account alone. They see a positive balance and they think things are okay, but they probably have a negative position on their current assets. I think I don't think it's a question of the terminology. I think it's actually a question of the understanding, as Ilya said, of how the P&L and the balance sheet work and combine together to give a complete picture of the business. And they have to understand that, where gross profit sits and where net profit sits, and what the relationship of those is through into the balance sheet. And that really, within smaller businesses, is severely lacking.
I suppose it's reiterating the importance of having up-to-date financial information that's meaningful to them. And so many businesses have their year-end accounts produced and they don't really understand what it means to their business, how that's actually affected their performance. If they can produce up-to-date, regular management information, then they can monitor these ratios, and it can really enable them to keep their finger on the pulse within their business as to what's going right and quickly spot anything that's adverse.
I think it's a lack of understanding, as Gaynor has said, of having to produce regular management information on a financial basis. And that isn't on a monthly or annual basis, but it's really on a weekly and daily basis. You need to understand the dynamics within the business and where everything is going. There is, I think, very much a reliance upon the annual accounts presented by their auditors or their firm of accountants, and these can often be 6 months behind the year end, and that means that some of the information is 18 months old and not particularly relevant to where that company is today.